The true origin of the 2008 financial crisis. What historians get wrong. On September 15th, 2008, a 158-year-old firm filed the largest bankruptcy in American history. Lehman Brothers, an investment bank that had survived the Civil War, two world wars, and the Great Depression, collapsed with more than $600 billion in assets. Within days, the entire global financial system was staring into an abyss. The story you have probably been told about how this happened goes something like this. Reckless people took out mortgages they could not afford. Greedy bankers lent to them anyway. The housing bubble burst, the loans went bad, and the system came crashing down. Greed and bad mortgages? Case closed. That story is not wrong exactly, but it is like explaining a plane crash by saying the plane hit the ground. It describes the impact. It does not explain what actually failed, because here is the part that should stop you. The total value of those bad subprime mortgages, the ones at the supposed heart of the crisis, was a few $100 billion. Painful but survivable for an economy the size of the United States. And yet the losses that cascaded through the system ran into the trillions. The damage was many times larger than the thing that supposedly caused it. So how does a few $100 billion of bad home loans nearly destroy the entire world economy? The answer is the real story of 2008, and it has almost nothing to do with irresponsible home buyers. It is a story about how Wall Street built a machine that took a modest pile of risky mortgages and multiplied the danger inside it by a factor of 10, 20, 50. It is a story about turning debt into a product, selling that product as if it were safe, and then betting on it until the bets themselves became bigger than the thing being bet on. The 2008 crisis was not caused by people buying houses. It was caused by what Wall Street built on top of those houses. Let me show you how the machine was assembled piece by piece. To understand it, we have to start with something that sounds boring but changed everything: the mortgage. For most of the 20th century, a mortgage was a simple personal thing. You went to your local bank. The banker, who often knew you, lent you money to buy a house. And here's the key detail. That bank then held your loan for 30 years on its own books. If you failed to pay, the bank lost money. So the bank had every reason on earth to make sure you could actually afford the house. The lender and the risk stayed together in the same building. That model was careful, slow, and stable. And Wall Street found a way to blow it apart. The tool they used was called securitization. Here's the idea. Instead of a bank holding 1,000 mortgages for 30 years, an investment bank would buy up those 1,000 mortgages, bundle them together into a single package, and sell slices of that package to investors around the world. The monthly payments from all those homeowners would flow through the package and out to the investors as a steady stream of income. This package had a name: a mortgage-backed security. Yes? And on the surface, it looked like a work of genius. It seemed to spread risk out across thousands of investors instead of concentrating it in one bank. It let money flow into the housing market from all over the globe. Pension funds in Norway and banks in Germany could now, in effect, invest in American suburbs. But look at what securitization quietly did to that old, careful relationship between the lender and the risk. It severed it completely. Now, the local lender who signed your mortgage did not keep it. They sold it within weeks, collecting a fee. Whoever bought it bundled it and sold it again. The risk was passed down the line, again and again, until it ended up with some investor thousands of miles away who had never met you and never would. Think about what that does to incentive. If the lender no longer bears the loss when a loan goes bad, why would the lender care whether the loan is any good? Their profit now comes not from making sound loans, but from making as many loans as possible, because each one generates a fee before it is passed on. Boy, the entire purpose of the mortgage industry quietly flipped from lending carefully to lending constantly. This is the first and most important piece of the machine. Securitization broke the link between making a loan and being responsible for it. Everything else grew out of that. Once volume became the goal, the industry ran into a simple problem. It ran out of safe borrowers. Everyone with good credit who wanted a house was getting one. But the machine demanded more mortgages to bundle and sell. So the industry went looking further down. Enter the subprime mortgage. Subprime simply meant lending to borrowers who would previously have been considered too risky. People with low incomes, poor credit histories, or no documented saving. In the old world, these people were turned away. In the new world, they were a gold mine because they represented fresh raw material to feed the machine. And the loans got creative in dangerous ways. Ah, wow. There were adjustable rate mortgages that started with a low teaser rate, luring the borrower in, then reset to a much higher rate a few years later. There were loans requiring no down payment, and loans that required no proof of income at all. which came to be known without irony as liar loan. To the person on the ground, none of this felt like a trap. Housing prices had been rising for years. The assumption underneath the entire system was simple and unquestioned. House prices always go up. If prices always rise, then even a risky borrower is safe. Because if they cannot pay, they can just sell the house for more than they owe or refinance. The rising market was believed to cover every sin, so the loans flowed. But we still have not reached the part that turned a bad lending cycle into a global catastrophe. For that, we need the second piece of the machine. And it is where things get genuinely strange. The investment banks now had these mortgage-backed securities, bundles of home loans. Yes, sir, but a lot of the loans inside were subprime. And openly risky loans are hard to sell to cautious investors like pension funds, which are often legally required to buy only very safe assets. Wall Street needed a way to take this risky material and make it look safe. So they built something new, the collateralized debt obligation, or CDO. Here's the trick, and it is a kind of financial alchemy. You take a pile of mortgage-backed securities, including a lot of the risky subprime ones. You pour them all together, and then you divide the resulting pool into layers called tranches, based on who gets paid first. The top layer gets first claim on all the incoming mortgage payments. The middle layer gets paid next. The bottom layer gets whatever is left and absorbs the first losses. And now comes the sleight of hand. Because the top layer gets paid first out of a huge pool, the argument was made that this top tranche was extraordinarily safe. Even if some of the underlying loans defaulted, the reasoning went, there would still be more than enough money flowing in to pay the top layer in full. So a CDO built largely out of risky subprime mortgages could produce a top slice that was declared as safe as a government bond. You had, in theory, manufactured gold out of lead. Risky loans went in one end, and a supposedly rock-solid, ultra-safe investment came out the other. But a claim of safety is only worth something if a trusted authority confirms it. And this brings us to the third piece of the machine, the piece without which none of it could have worked. The credit rating agencies. Companies like Moody's, Standard & Poor's, and Fitch exist to grade the safety of investment. Their highest grade, AAA, is meant to signal the safest possible asset, the financial equivalent of a fireproof vault. Investors around the world rely on these ratings to tell risk from safety, and the agencies stamped AAA onto these subprime CDOs on an enormous scale. See? By some estimates, around 80% of a typical CDO's slices received that top-tier, ultra-safe rating, even though they were built from shaky loans. Why would they do this? Here is the rotten heart of the whole system. The rating agencies were not paid by the investors relying on their judgment. They were paid by the very banks that were creating and selling the CDOs. The bank that built a product hired and paid the agency that graded it. Think about that conflict for a moment. If one agency was too cautious, too honest, and refused to hand out a AAA, the bank could simply walk across the street and take its business, and its fees, to a competitor who would. The agencies were locked in a race to please the banks. As one insider memorably put it, if they did not give the rating, the bank would just go to Moody's. Honesty became a competitive disadvantage. So the machine now had three pieces. Securitization, which broke the link between lending and responsibility. The CDO, which disguised risky loans as safe ones. All in the rating agencies, which put an official seal of safety on the disguise. Together, they took subprime mortgages and laundered them into assets that the most conservative investors in the world believed were rock solid and bought by the hundreds of billions. But there is a fourth piece, and it is the one that turned a large problem into an unlimited one. Because up to now, the danger was at least tied to the number of actual mortgages. There were only so many houses, so many loans. The fourth piece removed even that limit. That piece was the credit default swap. A credit default swap is, in plain terms, an insurance policy on a financial product. If you owned a mortgage-backed security and were worried it might fail, you could buy a credit default swap on it. If the security went bad, the seller of the swap had to pay you. It sounds sensible, even prudent, insurance against law. But there was a catch that changes everything. You did not have to own the thing you were insuring. Let that sink in. It is as if I could take out a fire insurance policy on your house, a house I do not own and have never lived in, and your neighbor could take out a policy on your house too. And a stranger in another country could take out 10 more. Suddenly, a single house burning down does not cause one loss. It causes a dozen payouts to a dozen people who had nothing to do with the house at all. That is exactly what happened. Credit default swaps let an unlimited number of investors place bets on the same pool of mortgages. The bet stopped being about protection and became pure speculation. Wagers on whether ordinary Americans would keep paying their loan. One regulator later described the resulting market bluntly as a casino, and through instruments called synthetic CDOs, Wall Street could construct entire products out of nothing but these bets, referencing mortgages without containing a single real one. This is how the danger was multiplied 10, 20, 50 times over. A single failing subprime mortgage was no longer a single loss, and it could sit at the center of a vast web of side bets worth many times its value. By the eve of the crisis, the market for these credit default swaps had swollen to a notional value in the tens of trillions of dollars, dwarfing the actual mortgages underneath. The tail had become vastly larger than the dog, and sitting at the center of that web, having sold protection on an enormous scale, was a single insurance company, AIG. It had written hundreds of billions of dollars in these swaps, collecting the premiums, confident it would never have to pay out. Because remember the assumption underneath everything: house prices always go up. Now watch what happens when that one assumption failed. Around 2006, house prices in the United States stopped rising, and then they began to fall. The entire structure had been built on the belief that this could not happen on a national scale. The models the banks and rating agencies used assumed that housing markets in different regions were independent, that a downturn in Florida would not coincide with one in California. So when prices fell everywhere at once, the machine did the one thing it was never designed to survive. The chain reaction was merciless. As prices fell, those adjustable rate mortgages reset to higher payments, and subprime borrowers who could never truly afford the loans began to default in waves. They could no longer sell their homes to escape because the homes were now worth less than the loan. By 2008, roughly a quarter of subprime mortgages were in default or foreclosure. Now follow the losses up through the machine. The defaulting mortgages meant the mortgage-backed securities built on them lost value, which meant the CDOs built on those lost value. And suddenly the AAA rating, the seal of safety, was exposed as a fiction. Assets that had been declared as safe as government bonds turned out to be worth pennies or nothing. Across the world, banks discovered that the safe assets on their books were toxic. Worse, because of the credit default swaps, no one knew who was truly exposed or how badly. Every institution suddenly suspected that every other institution might be hiding fatal losses. Trust, the one thing a financial system cannot function without, evaporated. Banks stopped lending to each other because no one knew who was about to go under. This is what a financial crisis actually is at its core. Not a lack of money, but a collapse of trust. The machine had made everyone's exposure invisible, and in a panic, invisible risk is assumed to be everywhere. In March 2008, the investment bank Bear Stearns collapsed and was sold in a fire sale backed by the Federal Reserve. In early September, the government seized the mortgage giants Fannie Mae and Freddie Mac. And then, on September 15th, the government let Lehman Brothers fail. That decision to let Lehman go turned a severe crisis into a global panic. Lehman was tied to countless other institutions through a dense web of these instruments. When it fell, no one could be sure who would be dragged down with it. Yasto. The following day, the government had to seize AIG, the insurer at the center of the swap web, with an initial rescue of $85 billion that would eventually swell to over $180 billion. Letting the insurer of the whole system collapse was a risk the government would not take. The panic spread far beyond Wall Street. Credit froze across the entire economy. Businesses that had nothing to do with mortgages suddenly could not borrow to make payroll. A money market fund, long considered as safe as cash, fell below the value of its deposits, an event so alarming it threatened to run on the foundations of the system. The crisis leapt from the financial world into the real one. Layoffs, foreclosures, shuttered businesses, and eventually a global recession that erased trillions in wealth and cost, millions of people their jobs and homes. So step back and look at the true shape of what happened, because it is so different from greed and bad mortgages. The subprime mortgages were the spark, but a spark only matters if you have built something explosive around it. And Wall Street had spent a decade building exactly that. They took a modest amount of risky debt. Through securitization, they severed the link between lending and responsibility, so no one in the chain cared about loan quality. Through CDOs, they disguised that risky debt as safe. Through captured rating agencies, they got an official seal of safety on the disguise. And through credit default swaps, they multiplied the total amount at stake far beyond the value of the underlying loans, until the bets dwarfed the reality. The bad mortgages were maybe a few hundred billion. The structure built on top of them put the entire global financial system at risk. That is the multiplication the simple story hides. And this reveals a pattern that reaches beyond 2008. Financial crises are rarely caused by the obvious visible risk that everyone can see. They are caused by complexity, by layers of cleverness that hide risk, move it around, and multiply it until no one, not the buyers, not the sellers, not the regulators, not even the people who built the machine, can any longer see where the danger actually sits. Each individual piece of the machine could be defended as rational. Securitization did spread capital efficiently. Insurance against default is a sensible idea. Rating agencies do provide a useful service. But assembled together and pushed to their limits by the simple desire for more fees, they created a system whose total risk was invisible to everyone inside it. The danger was not in any single part. It was in the way the parts combined. That is the deepest lesson of 2008 and the one most easily forgotten. The threat was not the borrower everyone could see. It was the structure no one could see through. The people at the center were not, for the most part, cartoon villains twirling their mustaches. They were ordinary people, each making a locally sensible decision, each collecting a fee, each passing the risk along to the next person, until the accumulated weight of all those sensible decisions brought down the house. The 2008 crisis did not begin with a family signing a mortgage they could not afford. It began the moment the person lending them the money stopped caring whether they could pay it back, because he already knew he would not be the one holding the loan when it failed. Everything else, the CDOs, the ratings, the swaps, the trillions, was just the machinery built to carry that one broken promise, at scale, to the entire world.